Good afternoon, everyone. My name is John Graham,
Are you on mute or are you good?
No, we're good.
Okay.
and National Accounts and ETFs at Arrow Capital Management. I'll be your host for today's call. Just off the top, there's a lot to go through today, so we're going to just jump right into it. But two things just to start with. One, just Arrow Capital's seen substantial growth over the past 3 years in both our firm AUM, as well as the advisors who are choosing to use us in their client portfolios. I just want to take a moment to acknowledge and thank you very much for your support and continued support, and we look forward to working with you in the future. Secondly, we just want to thank you for your patience. We had an unexpected technical glitch in the building, which we had to resolve on the fly, which hopefully we've done at this point. But we do appreciate your patience and staying with us today. Joining me today are Jim McGovern, CEO, founder, and portfolio manager at Arrow Capital Management, and Chung Kim, portfolio manager at Arrow Capital. What we're going to be doing today is going through our liquid alts platform. We have 3 of the 5 different products that both Jim and Chung manage for the firm. Jim and Chung will be discussing their respective portfolios, the markets they trade in, and their outlooks going forward, specifically with a focus on the process embedded in those strategies. So we're going to be really discussing and focusing on 3 strategies today. Arrow Global Advantage is the first on the left. As you go left to right on this page, the strategies from a risk return perspective move up and to the right, just like the table. So Arrow Global Advantage is the lowest volatility product that we offer. I find it to be a very unique offering because it can be used in a lot of different ways by advisors. The beta is 0, the correlation is 0, and it actually has a negative down capture, which is a testament to the team's active management of the portfolio. In essence, what that means is that on days when the MSCI World has been down, the funds actually produced a positive return. So it's a great diversifier for any client portfolio, and that's managed by Jim as lead and team. The fund has been around since 2016 and its current iteration since about 2019 in a prospectus, that is as a liquid alternative. And most advisors who are using the fund at this point in time use it in one of really 2 ways. One is as a sort of a proxy for market neutral type strategies. So it fits in really well with other market neutral type strategies. Or secondly, as a pure fixed income replacement for clients who do not want to have a lot of fixed income holdings in the current environment. The second fund in the middle is the Arrow Canadian Advantage Alternative Class. ACAA, as we know it, as we've just recently launched an ETF version of this strategy, which is trading on the TSX. And it has a long-term track record of providing exceptional returns for clients, both risk-adjusted and total. The fund has outperformed the TSX by approximately 200% since inception, and has done so with about 45% less standard deviation and very low beta compared to its peers. Jim is one of the co-managers for that fund and runs it in conjunction with Chung. And then we get to the global opportunities, which has been around for almost 3 years now. We're just a couple months short of the 3-year track record. It's off to a phenomenally good start, but it would be from an equity standpoint, a core equity holding, which would enhance returns for clients looking to try to achieve higher levels of return on the equity side of their portfolios. And as I said, the fund's been around. We're just about to get to the 3rd anniversary of the product. But since inception, it's been compounding at about 28% net. So it's really done a great job of providing returns through very, very challenging markets. And with that, I'm going to pass it over to Jim McGovern for his comments and a deep dive into global markets.
Great. Thanks very much, John, and welcome everybody again. I'm going to presume that most of the folks on the call are sort of familiar with our macro model, which sort of an all-weather model that uses forecasting on inflation, real GDP, along with policy issues and their impact on those 2. So I won't spend a lot of time on that. A lot of people call it the sort of the quad model. And you know that the 2 key inputs are real GDP and headline CPI. So let's just start with the US. It's the biggest market in the world. Our view here going forward is that we think the next 9 to 12 months are going to be pretty slow. We're looking at our numbers are a little bit the inverse of what the market consensus or Bloomberg consensus is right now. We think the worst is going to be this quarter and possibly early into next quarter, and then becoming a bit more optimistic in the out quarters of this year. Consensus is a little bit the opposite of that. But regardless, at the end of the day, nobody's looking for anything particularly great here. I would highlight that that this framework is somewhat similar to, I was just listening to Stan Druckenmiller's Chung conference presentation or discussion, and saying how difficult the policy and the economic outlook is to try and forecast, and you need to have in a high degree of humility and also a lot of cushion, and definitely keeping an open mind. But based on our forecast right now, this is where we are in real GDP. The next slide looks at CPI. And here's where we may be a little bit more different from the consensus, and that everybody has headline CPI going down. This is not a surprise. You can see you had the peak in the second quarter of last year, and it's been trending down since then. The real issue for the market will be when it gets to this 3.5% level, and whether we can pierce through that consistently, or whether things get sticky for the next 6 months or so. And you can see the market has a nice trend down from 4.2 this quarter all the way to 2.8 in the first quarter of 24. Ours, you can see we kind of stalled out in the 3.70 area. And we can talk a little bit about that, or we will talk a little bit about that. Obviously, the caveats now on the CPI and on GDP are things are now exogenous shocks that are probably no question of the results of the rapidly rising rate cycle that we've been in. So we've had a banking crisis. Whether that's the market accident, I don't know, but certainly we could have another one, or the debt ceiling is becoming an issue, or government finance is becoming an issue. All these things are going to ultimately play into what happens. But let's spend a bit of time on CPI. So the next slide shows you what's been going on with Fed funds in the black line, rapid increase that you can see there. And maybe just a quick reminder, we haven't been in this hiking cycle for very long, sort of 13, 14 months now. And usually most economics models are sort of 12 to 18 months lag on this policy. So it's really just starting to bite now. And so for context, that last 25 bips that was done earlier won't have a real impact for another 12 months or so. So we've got a lot of pressure, obviously, building in the rates market. That Fed funds rate is now through headline CPI, which is just below 5, and Fed funds effective is just over 5. So that's good news. It's most likely that the Fed is done or very near done on rate hike side, and perhaps now they can pause, and that's already starting to get priced in the stir market now, especially with these other banking threats and tightening credit. So if we go to the next slide, what's interesting then is what does the market think going forward? You can see here the terminal rate, which is the peak, or where the cycle ends for. These are different markets: Canada, the US, Europe, and so on. And what you'll see on the far column is the 1-year implied change from terminal. So that just means how much of those terminal rates going to fall in the next 12 months. And you can see here they're going to fall hard. So the market's pricing in a lot of rate cuts. There's actually a small percentage chance of a rate cut in June, believe it or not, very, very small. But regardless, people are cognizant of the issues, and we'll go through some of those right now. Whether this happens or not is probably one of the bigger issues. Clearly, the market thinks it's going to happen. In other words, rate cuts at the back half of this year. We're not so sure it's going to be that aggressive. But anyways, let's take a look at some of the data here. Next slide. So soft data. So when you've been looking at PMIs, ISMs, all kinds of different survey-based data, all of these things are pointing towards a healthy fall in GDP and growth. The LEI, which is a conference board aggregation of a number of different financial and non-financial data points, is pointing to a recession. So very much this is kind of in the back of the market's mind now. It's a recession, but the issue being, is it a sort of a softish kind of recession, or is it more of a hard landing? Let's look at the next slide here. This is lending standards, or what is known in market parlance as the SLOOS report. So it's a senior loan officer's report that's the recent release is showing very high levels and rapidly rising levels. Now, this just happens to be almost perfectly correlated with Fed funds rates. So as rates have gone higher, standards have gotten tougher. And we're probably at that point in the cycle where people will lend to you only if you don't need the money. We're obviously seeing not much stress yet in the high yield market, but given the structure of the high yield market, there's a little bit of time before the refinancing needs really get more dramatic. But that being said, the covenants in a lot of these recent issues are quite light, quite lax. So we think that might add to the problems and down the road. The next thing that's getting a lot of attention on the next slide is the debt ceiling issue. And this is just a chart of sort of 5-year CDS on the US. That figure is sort of pointing to a 4 to 5% chance of a US default. I mean, obviously, I think that's a massive exaggeration. In some instances, the US is going bankrupt, but it is something that if one looks back at, say, 2011, where those CDS rates are through the 2011 peaks, which was the last really serious debt ceiling crisis, so to speak. And a lot of people are arguing that the setup in Congress right now is going to be such that it's going to be a pretty nasty outcome. And if you remember back in 2011, the bond market did extremely well. The stock market did very bad, and we had lots of volatility, but ultimately it was resolved. But this is certainly a short-term weighing on the market. The next slide just shows going back to this CPI issue. So, we do think it's going to be a little sticky here. And it's sticky because of the services side. So services in the economy is, much larger than, say, the goods side. That bottom panel there shows you the goods disinflation that's been going on really since the start of 22. It's a straight down, although it is now starting to hook back up, which I don't think a lot of people are paying attention to, but it is something that we're watching given what's happened with inventories and so on. But services inflation is really a function of either long-term inflation expectations, or it's a function of demand or slack in the labor market. And so that's why the Fed and others are so focused on the labor issue. You can see here that these different measures that the Fed likes to look at, especially core services, less shelter, because people know that this shelter operates with this lag, is trending down. But again, how fast is it going to come down? And is it going to get anywhere near the Fed target of 2%? We would argue this could be a little bit more time consuming than something. The next slide just shows one of the reasons why, and that's this labor supply demand gap. Now, these data aren't perfect. You're looking at the Atlanta Fed's JOLTS data. There's lots of issues with it, but I think the basic premise of the story is that if you look in the middle panel, something like 3.7 million net job openings versus those unemployed is a pretty big number. Whether it's totally accurate or not, it really doesn't matter. There just is more demand for workers than currently available. And that obviously puts some pressure on wages. We are seeing that moderate. You can see those spreads starting to trend down now between the quits rate and the job openings rate in particular. But that's typically at a level of 2.5, and you can see it's right now it's quite elevated, more like 3 or 4. Next slide. One of the more leading indicators are claims, jobless claims. Here we're starting to get some tick ups. So the initial claims this morning were the highest they've been since late 21. You know, a lot of folks are, and particularly the Fed, they won't say it, but they're looking forward to this number to go up a lot more. Average recession starts with something over 400,000 claims. So let's see what happens here. It is a slow grind, and probably not happening fast enough for the Fed. Next slide just shows that these different wage proxies, actually some of the proxies actually hooked up back up in this past reporting period, which again the Fed's not going to be super happy with, and that's because you know, at the end of the day, you know, wages are a key component of nominal national income. So just go to the next slide. That proxy that we use, this is just a loose proxy. You know, you just take the payrolls times the average hourly earnings times the change in weekly hours and so on. You can see here, again, it's been a slow grind down. Nominal GDP, you know, was enormous coming out of COVID, and it's been falling along with this nominal income. But again, it's quite high. It's over the long-term average. And as a result, you've seen a lot of resilience in the economy. And that's despite the Fed rate hike. So obviously, we're going to come to a point where these things meet, and perhaps it'll be an accelerated or rapid decline. But for now, it's been quite orderly. Go to the next slide. So in terms of the stock market, so if you've got nominal income, and the stock market is really a proxy for nominal activity because it's price times quantity, right? And the inputs right now for the businesses, they're seeing finally a little bit of a squeeze going on. You can see the change in nominal GDP, which is directly tied into nominal sales for businesses, obviously less the employment cost index, and that's the measure of the inputs for a lot of businesses, especially in the service sector, is wages, right? So you start to see that bottom paddle, that number come down now. It's not, it's at a level where we're kind of equilibrating here. And again, when you overlay on the rates cycle and some of the other issues going on, we think this is going to start to turn negative, more negative. And Chung will have more to say about that in a minute. But, you know, obviously for some companies that have been able to pass along those costs, and when nominal GDP is still so high, you know, some of these, for example, staples companies like Pepsi or Mondelez and Hershey's and these guys have actually been making more money as they've gone forward because they've got these economies of scale and tremendous cost of capital advantages versus other businesses. So on the S&P, as we said, we started to see this roll down. You can see the delta up there at the top, the 226 or 218 number. That's earnings on the S&P. That's come in a little bit, but it just recently had another little tick up. And again, the Fed's not going to be super excited about that because really to get the wages under control, you're going to have to get the unemployment rate up, which means you're going to have to fire people. Unfortunately, usually that doesn't happen when profits are rising. So that's one issue. Look to the next chart. This looks at SLUs against the EPS growth. So these are tightening credit conditions. What happens to S&P earnings when this goes on? Well, there's a really strong correlation here. And again, with the SLUs at such high levels, go to the next slide. You can see that we think the profit cycle is going to inflect. Just a couple of comments on the global side. So this is a global fund. So our model extends into, you know, Japan, Eurozone, Canada, China, pretty much anywhere. You can look at these different forecasts. And I would say that, you know, definitely the most interesting market for us right now would be Japan. Japan is moving into a classic sort of quad one model where we've got real growth accelerating and inflation falling. Actually, if you go to the next slide, please. Yeah. So we think it's a pretty attractive entry point for Japanese equities. We also think there's a potential for currency appreciation. The Japanese cycle CPI is still it's still in a solid uptrend, and we think there is potential for a change in policy there. albeit they're taking their sweet time as it's customary for the Japanese, but we do think there's some interesting opportunities there across a lot of different industries. The U.S., I just to summarize, we're not super excited about the risk-taking environment there. China, like Japan, the model says all clear, but that we're noticing this post-COVID balance is really faltering, and consumption has been much weaker than expected. And that was seen in the import numbers just this week, extremely poor. And China is just having a hell of a time trying to refocus its economy on the consumer away from the capital goods and industries. And so far it's failing at that. So we're on the sidelines in China. Japan, I told you, liked. And Europe has, again, been a tremendous outperformer recently. We're now looking to fade that because the cycle is basically caught up. A lot of the money that's rotated back in Europe has been more cyclical in nature. And on the back of the ECB raising rates, there's been net capital flows back into Europe. But we think that's pretty much exhausted. So in terms of positioning, fixed income, a lot of T-bills, a lot of short-term paper, Canada, US. We are long a fair amount of short-term investment grade. But we're looking to opportunistically add to duration. We're now, once inflation breaks that 5% level, things start to become more normal in terms of a cycle predictability, aside from some of these other issues that are hanging around right now. But we are looking to add duration. Equities were, again, defensive, long Japan, neutral US, short Europe. FX, we're minimum long USD. Normally we'd be long a lot of US dollars right here, but again, the debt ceiling issue creates more than just noise based on past experiences. We have to be careful with your capital. We're long gold as a hedge to FX fall, and commodities, we're nowhere right now. Typically commodities are short in this kind of environment, but again, the dynamics here are changing a little bit, and we just elected not to be in this area right now. Last slide to sum up on the long short piece. So, we have these two pieces that just talked a little bit about the pure macro. These are derivatives and highly liquid instruments. Here it's long short equity. And, we're noticing a lot of interesting dispersion opportunities. So both in terms of sectors. So we're looking at obviously some of these defensive sectors. Our materials exposures are largely gold equities and lithium equities right now. Neutral on tech. I mean, tech is really starting to bifurcate with big cap AI related tech versus everything else. Short discretionary financials, cyclicals basically. And then on the factor side, long quality, short credit constrained, low volatility, and large cap is the bias. So probably spoken too long. So let me flip it over to my colleague Chung to take you through his portfolios.
Thanks, Jim. Thanks everyone for joining. So for those of you that have been on this call before or followed our views, some of this will be a bit of a reiteration of what we've been saying for the last few months. So not much has changed in terms of our defensive posturing. Although from my perspective, the level of conviction of a recession and a potentially harder one has actually increased over the last couple of months, given the regional bank crisis and the potential kind of downstream knock-on effects to the economy. So as the slide shows, our base case has been for a recession since the second half of last year. And we've kind of positioned cautiously until we kind of see signs of kind of earnings catching down on that basis, or leading indicators bottoming for us to kind of feel more comfortable taking risk. And so we'd be the first to admit that this has probably taken longer to play out than we originally envisioned. But we still think the risk reward is not in your favor to be too aggressive in the markets. And so with that, our exposures are still reasonably tight and reduced. And our tactical strategies have kind of increased. So kind of taking a step back, bigger picture, our kind of longer held or our long-term or long held view has been that the markets have been fueled over the last 13 years, maybe more, by excess liquidity, creating a misallocation of capital into certain areas of the market. And this, alongside some pretty strong market narratives, is how bubbles are created. And this is reminiscent of prior cycles, whether it's the dot-com crash or the Nifty 50 in the 70s. But we think a lot of these forces that were driving the markets higher are now reversing and happening the last couple of years. And the prior leadership that took us up will not necessarily be the leaders in the next cycle. But in between, we do think there has to be a reset before we start a new cycle. We think we're currently in that. And here's just a list of some of the themes, obviously not exhaustive. This is just kind of purely my opinion, that I believe have been tailwinds that are now turning to headwinds. And central to them all is inflation, obviously, which is either coincident or a main driver of a lot of these forces. So even though the recession call is pretty complicated, lots of factors in play to try to kind of come to a conclusion. We're not macro. I mean, I'm not a macro manager, but I think we take a probabilistic view of this when it comes to taking risk on and off. And if you just kind of look at prior cycles, inflation or a high inflation rate has been a pretty good indicator of recessions. And generally speaking, the higher the inflation it is, the higher likelihood of a recession. So this chart basically shows the gray bars are recessions. The line is CPI. And every time CPI got greater than 5%, a recession followed. Obviously, sequencing and timing can vary depending on context. But this intuitively makes sense for us, as higher inflation would necessitate a more aggressive tightening policy and ultimately run the risk of a sharper slowdown. So this is a pretty simple chart that kind of shows kind of that probabilistic scenario. So, I mean, given that view, it's the market's pretty resilient. The economic indicators are pretty resilient. There's many that are saying that this is the most consensus recession call ever, and the most bearishly positioned on that basis. And in the face of it, the data is still pretty strong. The markets are still pretty resilient, which for some would be the evidence of a soft landing. So we would kind of push back on that, kind of plays to what Jim said earlier about the lag. And, it's only been 14, 15 months. The first hike was in March, and not the more aggressive hikes didn't take place until kind of the summer. So we're just entering that period where historically you start to feel it, kind of 12 months minimum, and kind of extends from there. So we think it hasn't happened yet, and it's coming, which is why we're still pretty convicted on that view. And we'll kind of jump to the next slide. So the thing that's changed since our last update is the regional banking crisis. And so even though the economic indicators are still pretty good, in our view, this is a sign that things are starting to break. And, this is not something that would have been forecast. Well, a lot of people say in hindsight that was forecastable, but clearly not that obvious. We were kind of lucky to be short SVB, but it wasn't because we thought there was going to be a run or some sort of mismatch in terms of short and long duration. It was just a thematic call because they were the venture capital bank, and we kind of like being short that theme. But in our view, what's happened and happening, which we don't think is over, is going to accelerate the downturn, and it only increases the likelihood of a recession. So on the left is a chart, and so there's some replication here to kind of what Jim was saying, but this is the most recent kind of SLOOS consumer lending metric, and the consumer credit was already tightening before this before SVB, but as you can see, kind of the orange line, it's really kind of gotten much tighter recently over the last month, and historically, the times that it's been this tight, every time a recession has followed. Again, there's a lag here, so you're probably not going to see that really impact the economy for another couple of quarters. But coincidentally, in our view, part of the reason that the economy has kind of maintained some resilience is the super high savings rate that has been juiced by unprecedented policy. So the chart on the right kind of shows where that savings rate was and went to with the fiscal stimulus, and a bit of a projection of when it normalizes to kind of pre-COVID norms. And that kind of coincides with kind of late this year, again, potentially coinciding with the impact of the tightening lending standards. So all this leads to fundamentals at the end of the day. And we've been holding this view that earnings are too high, that they need to come down, and they have been. So the peak was mid 2022. They've been steadily coming down, although admittedly with this earnings season, they've been kind of ticking up a bit. I would say part of that is a lot of the big cap effect, big weights, big impact. But if you kind of look at this table, this is just from one broker, and it kind of gives you a picture of where consensus earnings is right now. So I would flag kind of the quarterly numbers for 2023. So $51 in Q1, $55 in Q2, $58 and $59 in Q3 and Q4. I guess what's notable for me is that $58 and $59 for H2 23 implies 3% growth for Q3 and almost 10% growth in Q4. Based on kind of what we just said in terms of where we think the economy could be going, we think this is farcical and pretty optimistic. And we think ultimately that's going to have to come down. So that's some of the kind of economic data stuff, but we don't think it's happening in a vacuum. I think the signs are there and developing in the market that are giving you warning signs every month. So even though the NASDAQ might be up 15% or whatever it is so far year to date, the S&P is up 7%. When you do look underneath the hood and you kind of look at some indicators that are pretty good historical kind of risk on, risk off indicators, they're not really telling a very good story. So maybe the most worrisome thing, at least from my standpoint, is how poor breadth is. So the top left chart. So this is credit to my buddy Sid Mokhtari at CIBC, and he's quite the chartist with lots of lines. But so the top left chart. So the top line is the S&P equal weight index, and that doesn't look nearly as good, at least from a chart perspective, as the S&P. And the bottom line is the relative performance of the S&P versus the equal weight index, basically just showing that the market has been, and I'm sure everyone's kind of heard this, been propped up by the big caps most of the year. I think I read a stat that 90% of the move in the S&P so far this year have been driven by 7 stocks. So a very narrow breadth, in our view, isn't the precursor to a bull market. The top right is the Russell 2000. Similarly, usually a risk-on barometer that looks like it's ready to break a key level. Bottom left is the copper gold ratio, which is today copper is actually breaking down from kind of a recent trend line. And so that kind of gives us pause. And the bottom right is the Dow Transport Index, which again is a pretty good historical leading indicator. So where do we think earnings are going? Again, they've been pretty sticky to this point, and Q1 earnings, which is almost done, is actually pretty sticky. So there's been this setup the last 3 quarters of people getting nervous into earnings and effectively them being not as bad as feared, and a bit of a relief rally. We think the same thing is happening as we speak, but ultimately, again, we think earnings are coming down. Typically in recessions, earnings fall about 20 to 25% from the peak to around 240, 250, mid 22. Taking that as a very crude metric, you could see earnings down to 200 or even below that. And when earnings fall, in our view, the multiple will come with it. Typically, an average multiple that it kind of settles down at is 15 times. So that kind of gets you to kind of 2,800 to 3,000 on the S&P. You know, when we were talking about this in October, a lot of people thought that was plausible, but now we're at 4,200. A lot of people think this is a bit of a joke, but we still think the likelihood is there. We still think we haven't seen the lows. And the question that we get a lot is, so at what point do you start taking on a bit more risk and feeling a bit more constructive? And this chart kind of shows, again, a bit of an overlay of recessions to kind of some of the leading indicators that we like to watch is kind of a bottoming of key indicators. And so we pay attention when stuff like claims have topped or stuff like ISM have bottomed. And those generally are signs for us that maybe it makes sense to kind of start taking a bit more risk. And I think that's coincidental with earnings, and we're well ahead of that at this point. So that's kind of our near to midterm outlook. Again, pretty cautious. Coming out on the other side, though, as I alluded to earlier, we do think that when a new bull market starts, it will be led by new leadership. And in our view, that new leadership will be cyclicals and resources, probably across the board. We think part of that's actually been happening for the last kind of 1 to 2 years in a stealth manner. And kind of this move that we've seen the last few months in kind of long duration and growth is actually more counter trend. But, you know, having said all that, that's kind of our view coming out on the other side. And we're preparing for that in terms of looking for fundamental ideas. So so this chart hasn't changed much since our last update. Cash levels are high, exposures are low, concentrations are low. Probably one of the bigger differences or kind of changes that we've made is we've reduced our energy exposure, increased our gold exposure, and we've started to add a decent amount of financial shorts. And that's kind of in conjunction with what I mentioned about the regional banks. So I believe there is this, I mean, bare minimum, there's some aggressive credit tightening happening and to come. We're open-minded to the idea that it could actually create a decent credit crunch / crisis. So we've built a basket of shorts on the financial side. Kind of Jim alluded to some of these as well. Stuff that so we used to be long REITs back in the day. We're net short those. So any companies that potentially have to roll over paper or exposed to the consumer that have a financing arm, again, we think as that slows down, activity slows down, and it becomes a bit of a negative cycle. So you could think about auto dealers and companies that are associated with that. I'm cautious about financials across the board. And, Canada, that's kind of almost a blasphemous comment given the weighting. But in times like these, in my view, I just don't think you know what you don't know. I think Manulife is a good example of that, obviously reported overnight. They have a lot of private stuff that has to be marked. That wasn't an issue before, but in times of deterioration, I think that could be something of a risk, much more of a heightened risk than people understand, in my view. And so we're doing a decent amount of work to build a basket there because we think there could be a lot of negative potential kind of a negative scenarios that could come. So that's it from my end, and I'll pass this back on to John to just kind of conclude.
That's great. Thanks very much, Chung. I appreciate it. Jim, that was an excellent job. We just covered a lot of ground. Have to take a breath. But just from a housekeeping perspective, we will be distributing this presentation to all of the attendees with a time-linked series to the video. So if you want to go back and go over anything, just because we were covering a lot of ground. Jim, that was an excellent summary, a very succinct summary on our global macros. Chung, that was great on getting into the fundamentals. I just have one question. I'm only going to pose one question. If you do have questions, just because we started late today, I think we'll just abridge this. Right. But the one thing that kind of sticks out to me is on gold. Chung, you mentioned it from the fundamental side, and Jim, you're coming at it from the macro side. I know it's been a great allocation for us on a year-to-date basis in the portfolios. If either one of you would just like to chat a little bit more about gold, how you're expressing it, where you think we are in the innings of it, what is because it's something that's very underrepresented in most client portfolios.
Yeah, I'll go first. So yeah, gold's a interesting asset. Obviously, everybody has a different view of what its purpose is in a portfolio, but for the most part, it is a diversifier. How it behaves, though, is within the quad framework. It's a good allocation right now for us. Where and how we've allocated, we have bought we've been rolling up out of the money calls on gold futures, and we're hedging those with the underlying. So we've actually tightened in our gold exposure a little bit today because gold does not perform well in a hard landing. So as the odds, as Chung alluded to, hard landing are going higher, gold becomes a source of funds. It's not that it's not a good asset. It's just that people need money and they sell everything except bonds. And because there's no yield on gold. So in a normal environment, and this I think is just going to ebb and flow. Like, so for example, I think going into the debt ceiling, gold will be bid. If we get a resolution, gold will probably not, but then kind of fall. So we've extended, we're sort of out into September, October for just a core position. And then we'll just delta trade around that. So right now would have about a 5% position. Physical.
That's great. Thanks, Jim. Chung, do you have anything to add to that?
Yeah, I mean, I'd say my views are similar. I probably express it with equities more so than Jim does. So probably our basket of exposure is a lot of gold royalty companies and also a couple of mid-cap gold names with reasonably low cost structures. So that's kind of how we express it. From a sectoral call, I think it's, a sector like any other where I think you have to be tactical. My current view in terms of why we like it is with inflation as well as rates, kind of the second derivative of rate hikes peaking. We think, and you've kind of seen it the last few months. The two biggest factors that have driven the gold price is basically real rates and the US dollar. And both of them look like they could be a bit toppy and have been for a few months. So I think that's, you kind of layer that on or overlay that onto the gold chart. There's a super tight correlation. And for now, we think that continues for the foreseeable. If and when we think that might change, we may kind of alter the positioning there, but that's our thinking in terms of our weighting.
Great. That's terrific. Thank you, Chung. So with that, I think we'll wrap up for today as we come towards market close. Thank you very much for your time and attention. Again, apologies for the late start today. We had a technical glitch that was unforeseen. We look forward to speaking with you soon. If you do have any questions, the team would be happy to address them. Please just reach out to your Aero sales representative for more information. The number is now up on the screen, emails, as I'm sure you're aware. And thank you very much for your time. Have a great day.